Welcome back to the channel, friends. Today, let's talk about 5 companies where retail investors have lost a lot of money. These names are very familiar. Vodafone Idea, Ola Electric, Gensol Engineering, Suzlon Energy, and Yes Bank. Let's understand how capital got eroded in these companies, what signals were ignored by many, and why extra caution is needed before putting money into such stocks. First, Vodafone Idea. Once a leading telecom player, now struggling just to survive. Losses have continued, and debt has climbed above 2 lakh crore. There's been dilution of equity, regular subscriber losses, and constant pressure from government dues. Even though there were hopes for a bailout, the stock has destroyed wealth for years. Every time there's some news, the stock might rally for a bit, but the core business is weak. The main indicator here was always negative cash flow and the crushing debt. That was the big warning sign. Next, Ola Electric. Many saw this as India's big electric vehicle moment, but the numbers have disappointed. Revenue fell almost by half compared to last year, and losses only got wider. The company is still burning money fast, and even auditors have pointed out problems in governance. Investors got pulled in by the excitement around electric vehicles, but at the end of the day, hype doesn't pay the bills. Strong numbers do. The big red flag has been the growing losses even as the company tried to become bigger. Then comes Gensol Engineering. This stock crashed over 90% in 2025. The reason? Serious allegations of funds being diverted by promoters and a big financial default. Even with intervention from regulators, it was too late for many retail investors. The renewable sector may be buzzing, but company ethics fell apart here. When there are doubts about the promoters or if official probes happen, it's best to avoid the stock altogether. Now, Suzlon Energy. This is a popular name among renewable energy stocks and was seen as a turnaround story. To be fair, there's some profit now. But if you check closely, much of that is because of adjustments like tax credits. Old debts, project delays, and low margins are still big challenges. Many investors assumed renewables meant guaranteed gains, but Suzlon's history of capital destruction warns otherwise. The lesson here: look at whether the company is actually reducing debt and generating genuine surplus funds before believing in the revival story. Lastly, Yes Bank. This was once one of the top private banks, but it crashed hard due to bad lending decisions and governance issues. Investors back then saw most of their capital wiped out. Yes Bank is back in profit now, and the bad loan ratio has come down. However, it still carries the problems of the past, and banking competition remains tough, so it hasn't really helped investors recover. For banks, always keep an eye on asset quality. Rising bad loans are a major warning. So, what's the takeaway for retail investors? Don't get swayed by excitement or low prices. Always check a few basics. Are the company's losses getting worse? Is debt manageable? Does the promoter have a good reputation? And is the business generating real cash? If not, then even a cheap stock can turn out to be a capital trap. Whenever there's talk about a turnaround or a hot new sector, look at the actual numbers and governance. Protecting capital is much more important than chasing the latest market buzz. That's it for today. Let me know in the comments, have you ever been stuck in any of these stocks? And don't forget to like, share, and subscribe for more such real-world investing discussions. Stay safe and make smart choices.